Hello everyone, and welcome back to our financial management series. I'm Gokul. I'm working as an assistant professor in the Department of Master of Business Administration stream in Sri Muthukumaran Institute of Technology. Today we are moving into part 4 of Unit 1 Foundations of Financial Management. In this session, we will shift our focus to valuation of bond shares and also introduce the foundational concept of risk and return. These topics are crucial for anyone looking into understand how financial market works, how investments are valued, and how to balance risk with potential rewards. Whether you are an aspiring investors, a finance students, or a manager making funding decision, this class will equip you with practical insights. In this part, we are going to cover two main areas, bonds and share valuation, how these securities are priced and what factors affect their value, risk and return, understanding the trades of that every investor and company must navigate. Let's start with bonds, a fundamental debt instrument in finance. What is a bond? A bond is essentially a legal contract or an IOU between a borrower and a lender. The borrower, which could be a government, corporation, or any other institutions, agrees to pay back the principal amount along with interest at specified intervals and a fixed maturity date. Think of it as a loan that you give to an organization, and in return, you receive regular interest payments and your money back at the end of the term. Bonds are long term debt securities, and while they offer a relatively stable income streams, they are not risk free. Like all investments, bonds carry risk such as default risk, interest rate risk, and inflation risk. Let's break down the key features that define a bond. First feature is long-term debt instrument. It usually issued for period longer than 1 year. Then coupon rate, fixed interest rate paid on the bond's face value. The nominal value, typically rupees 100 or rupees 1000, on which interest is calculated. Maturity, the predetermined date when the bond will be repaid. Redemption value, the amount repaid at maturity could be at par, at premium, or at a discounts. Market value, finally, the price at which the bond trades in the secondary market, which can be above or below its face value depending on interest rate and credit risk. Bonds come in different structure to suit varying investor needs. These are the various types of bond. First type is bond with maturity, second pure discount bond, third perpetual bond. First we will see the bond with maturity. Bond with maturity are the standard bonds that pay periodic interest and return principal at maturity. Pure discount bond issued at discount to face value and pay uh, no periodic interest. The return comes from the difference between purchase price and redemption value. Then perpetual bond. These are the bonds with no maturity date, paying interest forever. It's all also known as consoles. Each type serves different investment strategies and risk appetites. Next, yield to maturity. It is one of the most important measures of the bond's return. It represents the total return an investor can expect if the bond is held until maturity, accounting for annual interest income, coupon payments like any capital gain or loss relative to the purchase price. It is essentially the bond's internal rate of return. It can be calculated using financial calculators, Excel functions, or manually through trial and error method. It helps to compare bonds with the different prices, coupons, and maturities on an equal footing. Next, bond coupons. A bond coupon is its stated annual interest rate, usually paid semi-annually. It's expressed as a percentage of the bond's face value. For example, rupees 1000 bond with a 5 percentage coupon pays rupees 50 per year in interest, typically in two rupees 25 installments like that. Then we can move to the bond yield. Yield is a broad term referring to a return of bond investment. Different types of yield provide different insights. Two key types of bond yield are coupon yield and current yield. Coupon yield is the bond's stated interest rate. Current yield is the annual interest divided by bond's current market price. Understanding this helps the investor evaluate income potential relative to price. Then we can move on to the coupon yield and current yield. Coupon yield is simply the bond's annual interest rate as a set of issuance. It remains fixed throughout the bond's life and determines the periodic interest payments. Current yield equal to annual interest divided by current market price. Unlike coupon yield, current yield changes with the bond's market price. It tells you what return you are earning right now based on today's price, but it does not account for capital gains or losses at maturities. Now, let's transition to risk and return, a core principle in finance. Return is the gain or loss on an investment. For a stock, it includes dividends received and changes in share prices. Risk refers to the uncertainty or probability of earning a lower or negative return. Higher potential return usually comes with higher risk. I have given the formula for return also. Return equal to amount received minus amount invested into 100 divided by amount invested. For example, if you buy a stock at rupees 100 and sell it at rupees 120 means your return is 20 percentage. Then we can move to the next slide of study of risk and return. Historically, equity shares have delivered higher average returns than debt instruments like bonds. For instance, equities have averaged over 10% annually, while corporate bonds average 3 to 4 percentage. However, equities are also much more volatile. Their return uh, fluctuates significantly in the short run. This volatility represents risk, thus, the trade off is clear. Higher return potential comes with higher risk. So, how can we aim for higher return while managing risk? One effective strategy is diversification, investing in portfolio of securities rather than a single asset. Portfolio theory shows that by combining assets with different risk return profiles, we can reduce overall risk without proportionally reducing expected returns. But one thing you have to remember, stocks with highest potential returns also carry the highest chance of loss. Smart investing is about balance, not just chasing returns. To summarize, whether you are valuing a bond, accessing a stock, or building a portfolio, understanding return calculation and risk exposure is essential. In future session, we will dive deeper into portfolio theory, CAPM, and more advanced valuation model. In this slide, I have mentioned the formulas for the return of an investment. Kindly see to that. That's a wrap up of part 4 of Foundation of Financial Management. We have explored bond features, yields, and the fundamental relationship between risk and return. Key concepts for any finance professionals. If you found this video helpful, means please like, share, and subscribe for more structured finance lessons. Drop your questions in the comments. I'm here to help you all. Thank you for the learning with me. See you in the next class. Thank you.